All right. What's up, tycoons? What is up, traders? For today's video, I am going to give you guys an update on TLT and the bond market, as well as cover many important economic and financial condition settings that you all should truly be aware of. So if you're new to the channel, make sure to smash the like button and subscribe. Okay, I'm dropping content like this every single week. And if you've been watching my TLT videos and you've been enjoying those, stay tuned for those. I am going to get to TLT, but there's some important things that I really want to cover and some charts that I've made here that I really want to point out that are very important. Now, the first one we're looking at is going to be the S&P 500. Okay, that's going to be in purple here. And then we have the financial conditions as well as the adjusted national financial conditions here as well in blue and orange. So one thing I want to highlight, okay, is when the financial conditions hit their peak, right? So we see financial conditions hit their peak here. We are near a S&P 500 bottom, right? And shortly afterwards, we see it come back down, and that's when the stock market truly starts to rally. Jerome Powell's mission and the mission of the Fed, okay, is to tighten financial conditions. That's how they are going to bring inflation down. All right. At the end of the day, right now, that's all they're focused on. And so a really key level that we're at right now is we're actually baselining and we're actually touching a previous low, all right, on financial conditions. Okay, so again, once we see financial conditions really start to peak up here, that's when we get a bottom, all right, and then financial conditions start to come down. We see the market start to rally a little bit, okay, and then they go back up, they peak again up here, all right, and we bottom on the S&P 500 shortly before that, okay, then we rally, and once we see this bottom here, which we're currently retesting right now, okay, we see this bottom that marked our high, right? This was the August highs, okay? That was our summer rally, and the highs were marked by this bottom here in the financial conditions. Now, again, we are at the very bottom again, testing those levels. So the big question is, we've basically been rejecting this trend line on the S&P 500, and this is just, a very rough line. Okay, it's not the actual candlestick chart, but you can see that, we've basically been rejecting this trend line. We got rejected here again, and we started to drop on the S&P 500. And financial conditions are back at the similar bottom that we were at previously when we marked a market high and rejected that trend line. So there's, going to be a lot of stuff to watch in the market. Huge week next week, this upcoming week, full of catalysts. Okay, we have the CPI, then we have FOMC, and then we have another report on Thursday that's slipping my mind right now, but it's catalyst after catalyst after catalyst next week. So you really have to keep your eyes peeled. If financial conditions can break this, okay, and keep heading down, there's a strong sense that the market will continue to rally. But we have to keep in mind what is Jerome Powell's mission, and his mission right now is to tighten financial conditions so that inflation will come down. All right. That's basically what his goal is. Now, Jerome Powell did come off slightly dovish and really not as bearish as the last time he spoke at Jackson Hole in his last FOMC meeting, in his last speech that he gave, actually. And the reason being is because the bond market is looking terrible. Okay. The bond market has completely failed. All right. Especially this year. And what we're looking at right here is the leading indicator of a recession. Okay. The 10 2-year treasury yield and the 10 3-month treasury yield. When you see an inversion in these, this is a major indicator that we are going to have a recession, in the future for the US, right? And so what we're seeing now is we're seeing the 10-year 3-month treasury yield is inverted. It's down negative 0.8%. And we're looking at the 10-year 2-year treasury yield. It's down negative 0.83%. So again, the bond market, which is much more massive than the stock market and much more important to the economy, is just looking absolutely terrible, right? And it's got a lot of people's attention right now. The Fed is doing quantitative tightening, something that's never been done before in history, and we truly don't know the economic impact. So a lot of people thought that, oh, well, he's really trying to get stocks to rally. What he's trying to do is he's trying to get the bond market to stop from collapsing, and really treasuries in specific. Um, so we'll move on to the next slide here. And what we're doing is we're looking at the same two things. Okay. We're looking at the 10-year and the 2-year treasury yield. Okay. The 10-year 3-month treasury yield. And then we're looking at the S&P 500 in itself. Right. And so what I want to highlight is that there's three really main levels that we could call bottoms on the 10-year 2-year treasury yield and the 10-year 3-month treasury yield. Okay. We are currently testing the bottoms right now from right around 2001, 2002 timeline. Okay. That's currently the level that we're at right now. Okay. And if we look at what happened, okay, this kind of marked a peak, all right, ultimately before a big drop in the market. Now, please don't mistake any of this for financial advice. I'm not out here telling you guys to short everything, telling you to long everything. What I'm trying to do is just give you guys some very good data. Okay. This is all factual data, and you can interpret that however you want and make your own decisions or consult with a financial advisor. But if we notice here, each time we get these bottoms, okay, on the yield inversions, what we see is that it's actually later in the future that the stock market actually comes down and has its crash, right? So, right here, the stock market's looking good. And then we fast forward into the future, and that's when the stock market really starts to collapse. So, we may get some short-term rallies. We may get a Santa rally. We may do good heading into Q1, Q2 of 2023. But we have to, just be aware that, these the 10-year 3-month and the 10-year 2-year treasury yield spreads, when those are inverted, those have always led to a recession and ultimately always led into a stock market crash, right? And into a large decline. And this is why people are saying that, hey, the market may still create new lows in the future, but for right now, things are a little bit indecisive. We'll cover some of the data and some of the momentum, which is going to be really key for, if you're a day trader, if you're a swing trader and you're looking to capitalize off of some short-term opportunities. We'll take a look at that. But I really just want to highlight, how, what, like, for here we get a bottom, and then the S&P comes over, and then the S&P actually bottoms, right? And we get these yield curve inversions, and it's always been an indicator of a recession. So we have to be very, very cautious and aware of that heading into 2023. We have to keep this, in our mind. All right. Now, here we are. We have the actual TLT chart. Okay. And this is the chart that I've been charting up for everyone. What we're looking at is a 5-wave impulsive Elliott wave structure. So we have our 1, 2, 3, 4, 5. Okay. You can also call these A, B, C, D, E. And your wave A, your wave C, and your wave E, those are going to be your impulsive waves. And those are 5-wave structures, right? And so, throughout the entire year, we've been following these structures, right? So you have your 1 wave down, your 2 wave up, your 3 wave down, your 4 wave up, and then your 5 wave down. And then your 2 wave and your 4 wave, or your B wave and your D wave, okay, those are going to be what's known as corrective waves. And so what you do is you get an ABC correction, right? And so we see we have an A here, we have a B here, and then we have a C correction that marks the finish of our A to B wave. All right. And we reject right here at the 61.8% retracement level, right? And so what that is that's the Fibonacci tool. And you basically take your swing high right here, you connect it to your swing low, and you see we come down, then we retrace up to the major retracement levels, get rejected, ultimately continue the downtrend, right? And, after we get that ABC, what do we get again? All right, we get our our C wave right here, or a 3 wave, and that's marked by another impulsive wave that has 5 waves, and we see we get that again, 1, 2, 3, 4, 5, right? And so now we're looking at a wave 4, and we're in the process of our wave 4, and look exactly where we rejected. Okay, I've been making the videos for the past week or two on TLT. And I've started to cover it a lot more because it's actually gotten a little bit of response in the comment section. So if you're enjoying this video, and you like this content, make sure to let me know in the comments down below if you want to see more of this coverage, because I really go by what the viewers are telling me and what the viewers want. I don't want to really, waste my time on stuff that's, people aren't really interested in, right? So we got our 5 wave structure down, and then we could have possibly marked our ABC correction wave to the upside, finishing our wave 4 or our wave D, right? And look, we got a perfect rejection here at the 61.8% retracement level. Again, what we're doing is taking our swing high up here, connecting it down to the swing low. Nothing is going to move in a straight line up or down. It's going to come down, retrace, continue the trend, right? And so we're seeing that we came down, we got a perfect retracement up to the 61.8% retracement level, and possibly we're starting our downtrend. Now, again, there's so many catalysts coming up in this, following week. A lot of people are probably going to be shaken out. And we could see a pop, right? We have this gap right here in blue, and we have this gap right here in blue as well. So, we may be pulling back, but we could actually get a bullish CPI print. Jerome Powell could come out and kind of talk the market up a little bit again, as he's very worried about, the treasury and bond market. It's a huge market, much bigger than the stock market, and he may try to come off a little bit more dovish, or not even dovish, but just not sound super hawkish, because he doesn't want that market to collapse any more than it already has. So, we were able to capitalize on some short positions this week, right? I'm recording this at the on Friday night. In the very beginning of the week, we did have some bearish, activity in the market, and lots of people did good in the Discord, trading some shorts. So if you want to be a part of our trading community, get my intraday thought process, and really get, live market updates on what we're seeing as it's happening, make sure to join the Discord. Use the link in the description below, and you can also use the coupon code Zackley, like the channel name Zackley Trades. That will get you a discount on your membership. But we're going to go ahead and continue on. So for right now, the structure is looking like we did get our ABC wave up, but I did mention that if we come up here and we retrace to these three levels, right, 101, 100, and 98.54, there's a chance, okay, that the market could actually turn this into an impulsive wave, a 5 wave structure, which wouldn't be a correction wave, and possibly negate out all of this, okay? So, we really have to see what's going to happen. Maybe CPI and maybe, this Fed meeting is going to be, the catalyst that really propulses us out of this and tries to get a reversal in the market, versus, hitting our targets down here. The main thing we're looking at, because TLT has been one of the leading indicators, is we're looking for a MACD crossover, right? So this is our MACD right here. And I just want to highlight, these arrows right here. Every time we've gotten a blue line to cross below the orange line, this is a MACD crossover, specifically a bearish crossover. And if you look right here, we got our MACD crossover, and then we had a huge downtrend, right? Right here, we got a MACD crossover, and then we had a nice drop. Right here, we had a MACD crossover, we get a nice drop. Right here, we get a MACD crossover, we get a nice drop. So, that's really the signal that we're looking for on TLT, is because, TLT has been a very nice indicator, right? We were able to actually break this trend line here, this very long-term trend line, and get a breakout to the upside. And we haven't got the MACD crossover yet. So that's something that's really, really interesting, is that we really haven't gotten the full sell signal yet on TLT. But if we hop on over to the SPY chart looks a little bit more bearish, right? So when it comes to SPY, we did not break the major trend line that we've been, pretty much respecting all year, right? What did we do? We rejected that trend line again, right? So SPY is looking more bearish, but TLT is showing a little bit more strength. Okay, on SPY, we did get the MACD crossover, right? We got the MACD crossover right here. And this is what I was saying, the market was a little bit bearish this week, right? And we saw we had this could be a very tiny bear flag right here. I did mention that, hey, my last update, we broke this trend line here. It would make sense for us to come back up and retest this trend line right here. So what this is, these two trend lines, I'll go ahead and put some red arrows on here for you, so it's a little bit clearer. Okay, and what we're looking at is a pattern known as a rising wedge. This is a bearish chart pattern. Okay, and it's indicated by the price action zigzagging in between these areas. And ultimately, you look for a break to the downside, a retest of this trend line, and then a continuation to the downside. All right. Um, Again, the setup is very similar on the S&P 500, right? We're looking at a 5 wave structure down. So we have 1, 2, 3, 4, 5. And, your wave one is going to be a 5-wave structure. 1, 2, 3, 4, 5. All right. And then, your wave two is going to be that corrective wave. 1, 2, 3. All right. We got our corrective wave. And then here we have our 5-wave move down. 1, 2, 3, 4, 5. And then we have again, the correction wave. So, wave two and wave four, all right, are going to be corrective waves. So that means it's going to be a 3-wave pattern. All right. It's going to be an A, B, C, right? Your wave one, your wave three, and your wave five, those are going to be your 5-wave move. So we're going to look and see if we can get a 5-wave move to the downside, which would take the S&P 500 down to 350 all the way down to 330. But again, we really have to pay a close attention to TLT and see if it's going to give us those sell signals. Because if we come down to these support levels on SPY, all right, which is going to be 386, 379, and 372, there's a strong likelihood that we could end up, forming a D wave down here and then an E wave up here, creating a 5-wave impulsive move, possibly breaking this pattern that we've been following for the whole year. All right. Now we're going to move on to the VIX, which is the volatility index. And what I want to highlight on the VIX is that it is very one directional, right? So we're looking at the daily time frame. And what I mean by one directional is it stays in one direction for a month to 2 months, right? So we see it downtrending right here. Okay, it's downtrending, it's just going in a super downtrend. And then ultimately we get a breakout, a pullback, and then a continuation. And it's really just bullish here for a couple months. And then what do we see? The VIX pukes, right? For a couple months, we get a breakout and then a pullback and then a continuation, right? And this is where it's bullish for a couple months. And then what do we see again? All right, we see it downtrend right here for a long period of time. It breaks out, retests, and then continues up higher. If we look at what VIX is doing currently, right, it's been in this downtrend this whole time. We did get the breakout, but what I want to highlight is that we've always broken out and then had a nice pullback and ultimately continued higher, right? Over here, we broke out, we pulled back, and then we ultimately continued higher. I know it's a lot to process, but based on all the info that I've shown you guys in this video, I said, hey, watch for the fake out. We have 3 major catalysts next week. So if we do get some bullish prints on, the 3 catalysts next week, we already know that VIX always breaks out and then dumps. It dumps as soon as after it breaks out, right? We see a breakout and then a dump. So what would cause the VIX to dump? Well, what would cause it to dump would be some bullish catalysts, right? And we have 3 major catalysts coming in this next week. And so we can obviously see we break out and then we always have a dump. And then ultimately we reverse back again on the VIX and go up higher. And it stays one directional for, a month to 2 at a time. So that's all I'm saying is that, just because maybe next week may be bullish, you have to keep the big, kind of trend and then, the macro trend in mind, right? Now, we could get bearish catalysts next week. The reports and, Powell could come out and just tank the market, and that would align with everything that we have on TLT and SPY. But I'm just preparing myself in case things do come out bullish. You have to be ready to play both sides and really just take the data that you're getting and interpret it as best as you can. Now, the next thing we're looking at is the Skew index, okay? And so the Skew is similar to the VIX, but what it does is it actually measures out of the money protection, okay? So the VIX is measuring, people buying puts on the S&P 500. All right. Now those could be in the money puts, those could be at the money puts. The Skew specifically is looking at out of the money puts, right? And so this was last Friday, right? And if we go actually back to the SPY real quick, and we'll go back a couple charts, this right here was last Friday. So, we saw this top right here on the S&P 500, and that was on Friday. And then this week we got the bear flag set up. Okay. If we go to the Skew and take a look at that, this was that Friday. This was that large spike in out of the money protection, right? So keeping an eye on the skew index, we see that we actually have a bullish pattern known as a falling wedge. And this thing potentially could break out at any time, which would really, indicate that people are buying tons and tons and tons of out of the money put options and protection in the market. So, right now we did get a sharp drop in it after the spike. So we're really just going to keep an eye on this and see what's happening, right? If we see major spikes in this again, that could be an indicator that, hey, the market is about to drop in the near future. All right. The next thing we're going to look at is going to be SPY G versus SPY V. Okay. This is the S&P 500 growth sector versus the value sector. Now, this entire year, we've been trading in a bearish channel. What this means is that growth has been underperforming value for the entire year. Of course, this makes sense in a bear market and bear market environment and the economic conditions we have, right? What are investors gravitating more towards? They're gravitating more towards value plays. They're not looking for growth plays, right? You look at the ARK fund, completely trashed, right? So it makes sense to see the SPY G versus SPY V so down. What we're doing is this is actually giving us these are basically market sentiment charts, right? So you can look at this and kind of gauge the market sentiment. When you see this going up, right, the market is rallying, okay, and it's rotating and it's going from more risk off onto risk on, and it's going out of its value plays and back into growth, okay? So here, we do have another falling wedge right here, kind of a little bit of a triangle pattern. We're looking to see what's going to happen here. We're really right in between these two major trend lines. So this thing could break out to the upside. This thing could break out to the downside. We're really just monitoring and maintaining. Again, we're in this bearish channel, but currently we are trading on the upper half of the bearish channel, right? So this is the kind of like the halfway line right here. And we're trading above it right now. We haven't really been trading below it for a significant period of time, in the past few months. The next one we're going to look at is another market sentiment gauge. And this is XLU versus XBI. XLU is the utility sector. Okay. Again, this is one of the most risk off sectors. So when you see the market going risk off, you're going to see XLU outperform XBI. Now, XBI is the biotech sector, which is arguably one of the most risk on assets, right? Asset classes. When you think about biotech, what you're looking at is you're looking at companies, right, that are basically going in massive, massive debt to innovate and come up with these pharmaceutical drugs or whatever it is that they come up with. There's many different type of biotechs companies, but at the end of the day, they're spending a bunch of money in biotech science research, and they're going out of their way and taking massive loans, picking up massive debt, and sometimes they clear list that or they raise money by diluting their shares, right? So when you see XLU outperforming XBI, which means that this chart would be going up, what you're seeing is that the market is again more risk off, right? If you see this crashing, or that's a good indicator that the market is back to risk on. And this means that XLU is underperforming XBI. Well, what did we do? We have this nice triangle pattern right here, okay? And we actually just got a breakout retest and we're continuing up higher. Now, ultimately, what we've been tracking is this, big retracement, right? So we have this large, massive move to the upside. What did we do? We came down, we retraced, and we are holding above our 61.8% retracement level, right? And so it looks like a healthy retracement for a continuation to the upside. Once we break through these major three levels here to the downside, right, that's going to signify that the market is much more risk on, and we're in a more risk on environment. Now, for all of you bulls out there, okay, I have not forgot about you, okay? If I'm coming off super bearish in this video, I'm not trying to. I'm really just trying to show you guys, the data that I'm really looking at. In this chart, we're looking at the percentage of S&P 500 companies trading above their 200 simple moving average. Look at how high this has got. This is basically telling you is that there is a large percentage of stocks in the S&P 500 trading above their simple moving average, their 200 simple moving average to be specific. Now, why is this important? Well, there's many hedge funds, many institutions that simply look at the 200 moving average and say, is it above? Is it below? If it's above, we're long. If it's below, we're out of it or we're short, right? And so what we're seeing is we're seeing that there's a lot of stocks trading above their 200 simple moving average. Now, something I want to highlight is we're very close, okay, to the peaks, right? If we look over here, all right. We have about this much room left to the upside before we reach our previous highs, right? So we could come up some more, and that would put us at our previous highs right around in through here. But we have to ask ourselves, what are the market conditions, right? How is the economy looking? Does it make sense for us to be trading in so many stocks to be, trading above their 200 simple moving average? Well, if it seems like Powell is going to cut rates, if it seems like inflation is coming down, and it seems like the Fed is going to pivot to dovish, then we may be able to justify a rise in this. All right. Now, if we take a look at the next chart, it's actually going to be the percentage of S&P 500 companies trading above their 50 moving average, right? And their 50-day simple moving average. So these are two things that a lot of people look at to gauge market sentiment and gauge market momentum, right? And what we're seeing is we're seeing that we're actually near our most recent highs. Okay. We basically hit those highs and we're kind of trading in this range zone right here. Now, some people could call this a cup and handle, right? Something like this. But again, this isn't so much of a trading chart that you actually buy and, you go long or you go short on. This is more of just, a market sentiment and really gauging the percentage of stocks trading above their 50-day simple moving average. So it's important to note that we're at similar levels and we hit similar levels where we ended up dropping really hard. Look at what we did last time. We came up here, we dropped, we bottomed out right around this range, just like we're doing. We got a nice little pop and then we went and puked right below it. So, we may see stocks continue to trade above their 50 moving average. We may see another short-term pop this week due to many catalysts, right? And if they go bullish, we could see a short-term pop. But, if once that hype fades away, we could see things crash back down again. All right. So we have to keep all of this in mind and, really take in as much data as we can. Now, speaking of momentum and data and things like this, I want to highlight some things and really just one ticker in particular, the cows. Okay, ticker symbol COWZ. What we're looking at is a chart, comparing the returns of the Nasdaq, of the iShares Russell 2000, the S&P 500. Okay, and what you can do is you can see that currently, all right, the S&P 500 is down 14%. All right, the Russell 2000 is down 18%. The Nasdaq is down 28%. The cash cows ETF, okay, is actually up 4.65%. And what this is this tracks companies. This is the top 100 companies basically that track high cash flow. Okay, they have a high free cash flow. And that's something that's pretty important to people, in a bear market and in a, a tough economy and possible recession coming, is they want to look at companies with a high cash flow. All right. Now, the next chart we're going to be looking at is the momentum index, right? And so the previous two charts that we were looking at before the cash cows ETF was the momentum, basically a way to gauge momentum. Momentum is very important. And once when you're seeing the actual stocks themselves, right? Because you can look at the index and you can see the index trading above the 200 moving average or the 50 moving average. But if you don't see a large percentage of individuals, companies, and individual stocks trading above their respective moving averages, then that could be an indicator that, hey, maybe the indexes are just rallying and we're not actually seeing strength in individual equities, and that could be a bearish indicator, but that's not the case, right? And we just took a look at, it's a high number of stocks trading above their 50 moving average and a high number trading above their 200 moving average. Now, the S&P 500 Momentum Index is ticker symbol SPXM. And the main reason I'm bringing it up is because, again, it's outperforming the market currently, only down 12% versus the S&P 500 down about 15.5 or 15.85%. Now, I'm not telling you to go out and buy this. Again, this is not financial advice. What I actually want to do is bring to your attention that this gets rotated and rebalanced on March and September. Okay. And so what you can do is you can actually in March and September, these are the top 10 stocks, all right, top 10 constituents, and these are the sector weightings right here. Okay. So of the actual S&P 500 momentum index. So you can see last time it was rebalanced in September, the top stock was XOM. The top stocks were UNH, CVX, Berkshire Hathaway, Eli Lilly, AbbVie. Okay. And you can basically come in here and see what stocks have the top momentum, or, basically by their rules, right, at any given time, or specifically at the time of March and September. So, it may just be something for you to consider. And again, look at the sectors. Okay. You can see, okay, well, they were 30% in healthcare and 30% in energy. Tell me that does not sound defensive, right? Where's tech in here? Tech is not. Tech is 3.7% of the momentum index. That's not showing that there's lots of momentum in technology, right? It's showing that lots of the momentum is in defensive plays of healthcare and energy. And then you can actually go into those sectors yourself and look for individual companies, or you can look at the actual sectors themselves like XLE, and you can hop into XLE. Okay. So that's the whole reason that we just looked at SPXM and really brought that up. The next thing I want to highlight, all right, and this is basically going to be the top 10 worst stocks in the past month and how they performed, all right. And really just kind of, again, give you an idea of where some momentum is, right? So we looked at in September when they rebalanced it, we saw that there was a high, percentage of energy in the momentum index. Look at energy right now. We have 1, 2, 3, 4, 5, 6 stocks. 6 stocks are in the top 10 lowest performing in the past month, right? And we're looking at negative 20%, negative 12%, negative 5, negative 4. Okay. And it goes on and on. But these are just some things that you can start to look at yourself, and really start to track these things yourself to, start having some better gauges on the sentiment. And right here, this is going to be the top 10 performing stocks in the past month, right? In the past 30 days. We have Etsy, we have Wynn Resorts, we have Solar Edge, Bath and Body Works, we have Meta Platforms, guys. Meta. People think, there's been so much FUD surrounding Meta, and look at it. In the past month, it's up 26%. Now, one thing, and I do want to really highlight, is that there is tons of retail stocks right now. Retail has been super hot in the past month, right? We have internet retail right here. We have specialty retail, apparel retail. We have footwear and accessories. This is Nike, okay? Nike, at the end of the day, is a retail company. We're looking at Nike. We're looking at Ross. We're looking at Best Buy. We're looking at Bath and Body Works. We're looking at Etsy. Those are 5 companies right there, okay, that have been outperforming the market and have been the top 10 performing stocks in the past month. And they're all, retail related. So it's really, really interested. They're all consumer cyclicals. It's showing strong consumers. And, that's basically going to be it for today's video. Okay. So I hope you enjoyed it. All right. It's a new style of video. It's a little bit longer, but I went into a lot more detail on a lot of things. I still covered TLT and the bonds. Let me know in the comments down below what particular parts you like the most, right? Whether you want me to just stick to, some TA on the bond charts, or whether you appreciated some of this financial data and some of this economic data I provided in the video. Smash the like button, subscribe to the channel, and that's it.